Welcome to the Capital Discussions OptionVue Education webinar. I'm Tom Nonamaker with my guest, Steve Lentz from OptionVue Systems International. Before we get started, a quick disclosure that Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer-simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. And again, this is for educational purposes only. So with that out of the way, Steve, welcome back. It's always good to have you here.
Thanks, Tom. Okay. Let's see here. So I'm going to share my desktop, so help me out there. I can.
There's a share menu, or on the Quick Start tab, there's a.
Share my screen.
That looks like it's working.
Something good is happening. Okay.
Okay, I see a PowerPoint.
All right, then let me do that, and I think we're good. Now it filled up the whole screen, right?
It did, and I'll put myself on mute in case our pair starts making noises or something. But I'll be here.
Okay.
And if people ask questions or whatever, I'll just jump in.
Perfect. Thanks a lot. Folks, welcome. I'm Steve Lentz with OptionVue Systems. I run the Discover Options mentoring program here. It's the educational arm of OptionVue. OptionVue's been in business since 1983, producing high-end options analytics, and we've occupied that nice little niche for a long time now, and we're forever making improvements in our program to always stay on the cutting edge of analytics. Concurrently, though, Discover Options has a great mentoring curriculum, and we'll take you from beginner up to money management level if you want. And we have a great team here that'll, basically do a lot of hand-holding to get you through all the concepts. And, of course, we have a back trader program to help you scrimmage and drill in the markets before you actually go live. Today, I want to talk about a strategy that we've kind of keyed in on and some technology and research that I've been working about 3 years on now called Volatility Edge Analysis. But today, I want to talk about the hedged bullput spreads and their timing. And so and when we say timing, I mean actually looking at price action and trying to get in on these types of trades at times that are more likely to succeed than others. That's how we treat it. It's just a statistical model to try and instead of just going seasonally, saying putting on one of these premium selling strategies at the same time every month or every week or whatever, we actually look at the price action and try and time it using a technical analysis. Okay, so hedged bullput spreads, let's talk about that first. I love this picture. This is of Dustin Johnson. He's hitting what in golf is called a power fade. And it's analogous to trading in the sense that in golf, and Ben Hogan started this strategy, where he had a tendency to occasionally snap hook it to the left, being a right-handed golfer. And Ben Hogan he changed his swing famously. He shortened it up where he was then cutting the ball to the left side of the fairway and then fading it back in. And he adjusted his swing to basically completely remove the likelihood that he would hit it to the left. And he would instead hit it to the left and then curve it to the right. And so then he was just basically managing how much he curved the ball to the right. Jack Nicklaus adopted this philosophy as well in the next generation of golfers. And here you have Dustin Johnson doing the same thing. And it's a very effective thing. Now, in the world of trading, we like to, many of us have done butterflies and condors where we're trying to make money in a range-bound market, and we quite often get burned on the upside. Maybe I'm the only one, but when the market takes off on a tear, it's in a bull market, which it is a lot. It goes off on a tear to the upside and has 3 straight huge up days. That can wreak havoc on, butterflies and condors. So what if you had a strategy where you're basically removing that, the trouble that you could have on one side or the other, in this case, the market's upside. That's kind of what a bull-put spread does. And we're going to talk about a hedged bull-put spread in the sense that we're going to try and collect premium no matter which way the market goes, but particularly if the market goes up, we're not going to have the tremendous anxiety that you would have as a butterfly or a condor trader. So I want to go over that overview of a hedged bull-put spread and exactly what what the legs are. And this outline, by the way, is the exact one we use in our mentoring program for, that particular course in that sequence of courses that we teach. Today I'm going to cover the first two, most of the second one anyway, all of the first item, the overview, some of the second, and then the last two we're getting into the weeds here on, the secret sauce and how we determine exactly which strike and all that stuff. It's a very long presentation. I'm just going to cut it way down and talk about an overview of the hedge bull-put spread and then the timing part of this. All right? But these slides basically come from the same presentation that we use in our curriculum. So let's just talk about a hedged bull-put spread and what it looks like. So here we are in OptionVue. And in OptionVue, we have we can see that the put strikes are on the left. Across the top, we have the expirations. And this is called in OptionVue, it's our matrix. And it's just a different way of laying out options. If you go into a broker's platform, often you'll see calls and puts in a big, long column. Calls on the left, puts on the right, in a big, long column, which is great if you're a market maker and putting together synthetics and boxes and whatever, reversals and conversions. You can easily see those relationships. But for an off-the-floor trader like us, it's better to have it laid out where you have the expirations across the screen left to right. That way we can more quickly view the horizontal skews if there are any. All right, in terms of diagonals or calendars if we want. Here we're only looking at the vertical situation here, in this case, back when the expiration was October 8th. This is a bull-put spread where we're selling premium at the 2090, going out 20 points and buying premium, 5-lot at 620. We're collecting more than we're paying out, so we're covered there, and we're collecting a net credit. Net of the commissions. So that's just a simple bull-put spread. Now, when we add a hedge on it, we're coming up here to the at-the-money puts, the 2180. We're going long a single contract of the 2180, selling the next strike out at 2170. That is a bear put spread, a debit spread, a single contract debit spread. And it costs some money. We're paying out more than we're collecting, so it's a net debit coming out. Now, you'll note that we're not paying out more than what we collected, so we do have a net cash flow that's positive down here. So even if the market were to go up and up and up, and all four legs expire worthless, this would be the cash flow at expiration net of commissions. Okay? Now, one thing I want to point out is that you have an implied volatility of the long strike at 9.7 is quite a bit lower than the implied volatility of the strike that you're selling, of the contract that you're selling here. So this is a vertical skew that is really benefiting this particular hedge right here. So this hedge is really trading with the skew in a big way, and we're acquiring this hedge for a pretty good price. Now, what's nice is when you model this then, okay, here's the bull-put spread, the straight bull-put spread, where we have a short down here at the 2090, okay, the long down here at the 2070. This is the 20 points. We have the net credit coming in, and it works out to about a 9% yield on the capital required. When we then add the hedge, we're going to put the hedge right here in the middle, and it's going to cost us money so that the right-hand side is going to go down, not past the zero line, and then the hedge is going to kick in. It's going to lift the left side up, just like that. So now, if the market goes down, the hedge is kicking in, and we're making money on that debit spread in addition to the the credit we're bringing in, so that the left side is lifted higher and the right side is pushed down a little bit. So if the market goes up, we still make 6% at expiration. But if the market goes down and it all goes all the way and hits our short strike, it's modeling a loss of a roughly 1-to-1 relative to what we could make if the market just expires out, with just a standard deviation to the downside or less. Okay, so that is a hedged bull put spread. Now I want to model this. This is the beauty of OptionVue, is it's going to take a real good stab at modeling the two together and then at different time frames. So I've superimposed this. You can do this real easily in OptionVue using superimpose. But I'm just going to go to 5 days out. And this is where high-end analytics can really kick in and give you an accurate view. OptionVue is modeling shifts in the volatility, both in the vertical and horizontal skews, to get us this picture here. And I want to just point out that you can look at the market going up 1.7% and seeing the hedge is the red, straight bull put spread is the blue. And if the market goes down 1.7, you could see that we're losing money here on both of them, but certainly we're losing a lot less with the hedge. Now watch this. We're going to go out to 10 days out. And look at this. At 10 days out, look at the difference now. If the market goes down 1.7, we're actually still, it's projecting to make a little tiny bit of money. We would lose, of course, on the bull put spread without the hedge. And if it goes up 1.7, both of them make money. But here's what I want to show you that's quite significant. The difference between, if the market goes up, look at the difference between the hedged position and the bull put spread. Oops, time out. Okay, up here. It's about, 3.5 to maybe 5.5. Oh, shoot, I keep clicking. Give that about a 2% difference there. But if it goes down, you have a much greater difference here. So do you see that? If the market goes down, the difference between the two, between the hedge and the bull put spread is far greater than if it were to go up and you have that little difference. So yeah, you're losing out if it goes up, but you're losing out a lot less than what you're gaining if the market does go down against you. So I think that's just an interesting little difference here between the two positions that really renders the hedged bull put spread to be, I think, of great value, given that you're trading with the skew and it's creating a real nice risk profile picture in comparison. Okay, so that's an overview of the hedged bull put spread. Just one thing we do is we go out a standard deviation right here. To do that bull put spread, it's a 1 standard deviation. We're at the first strike outside the 1 standard deviation, and we have our own way of calculating the volatility to get this 1 standard deviation. I'll tell you about that in just a little bit, just real briefly. But at the end of the day, what I do is I use a skew-adjusted VIX number to get that. I don't just take the VIX and plug it in. I skew adjust it because the downside on the puts are a lot higher than the upside calls, so it's going to be a higher number than the VIX at the end of the day. But that's what we do to get that figure. Okay, now let's talk about entering these trades, these hedged bull put spreads. And what we do is use volatility edge analysis. I brought that up last time I was here presenting, and we did it in the context of condors and butterflies. We're going to use the same type of technology, only adapted to bull put spreads here. One moment. Let me get a sip of coffee. One sec. Okay. And the concept here that's important when we discuss volatility and whether in determining what times of what price action is more favorable than others, we have to really understand the notion that implied volatility, the options time premium, is implying volatility, and that's a prediction of the future. Statistical volatility, or actual or realized volatility, measures the past. And so when you look at any volatility chart, and here's OptionVue's, the implied volatility line, in this case in blue, is predicting the next 20, what the volatility is going to be for the next 20 days. The red line, statistical, is measuring what happened in the last 20 days. So you're looking at any given one particular point in time, you're looking at apples and oranges here. You can't just look at a given time frame like at the beginning of February, and say, aha, these options are undervalued. Well, that's not really necessarily the case, because this, at the beginning of February, that's a prediction of what the future holds, and the red line is measuring what happened in the past. You can't make that assumption given the gap between the two. So how do we bridge this, and how do we use these in that context? And so here's what we're going to do in building the infrastructure for coming up with an edge in selling premium through bull put spreads, hedged bull put spreads. We're building the infrastructure, okay? We're going to understand the implied 30-day move down. Now, I'm not saying understanding what implied volatility is. Specifically, I'm taking a derivation of that, and we're going to understand the implied 30-day move to the downside. Remember, we're only talking about bull put spreads. So I want to understand what the market is implying that the 30-day move to the downside is going to be. What are the options predicting? Okay, then we're going to look at what the actual 30-day move down is, what that looks like. Then, once we understand those two, I want to understand the random historical distribution of those two types and the baseline edge that we have. And then I want to determine the distribution of the two, actual and implied, in the context of a technical setup. Okay? And so we're building the apparatus this way. Let's first go to an implied 30-day move down. Here's a chart from a while ago, simply showing the SPX going up. The VIX has come down, wobbling around a little bit. It can't go to zero, obviously, so it wobbles around between 10 and 15. And the point here is that the VIX itself does not tell the picture. This is just a single number, 13, 14, whatever it is. That is a combination of measurements within the SPX cash options, both calls and puts, okay, at and around the money. And really what I want to do now is dive in deeper, and in diving in deeper to the VIX and the components of it, and we have to look at the SPX options in total. And what you'll notice here is that the out-of-the-money calls have lower implied volatilities than the out-of-the-money puts. So the SPX options, you can't just take one number and say that one number is a prediction of the upside move and the downside move together. You really need to come up with two values. One is a prediction of the upside, and another is a prediction of the downside, because the SPX options are clearly reflecting an expectation that if there's a downside move, it's predicting it to be more harsh and steep to the downside as it is an up move to the upside. I think we can see that by the vertical skew in multiple time frames here. Okay, so we notice that vertical skew, and this phenomena has been around in spades since 1987, and finally in 2011, the CBOE issued and began publishing a skew value, SKEW, and you could just put that symbol in, SKEW, or maybe $SKEW, and it is a measurement of that vertical skew. So when the vertical skew gets really steep, the skew value will go high, and when the vertical skew gets flat, then it'll get lower. And you can go on the CBOE website and they have a nice white paper. They have a description of it where it talks here about the tail risk that, particularly in a down move in the S&P, you'll see the tail risk way out of the money puts start blowing up in implied volatilities, and that affects the rest of the chain then. And so basically the skew values ranges from 100 to 150. And you can just kind of read the description here. But basically what I'm going to do is take the skew, and then through basically through an algorithm, I'm going to run the VIX value through the skew to derive two different values. So here we have the skew value in the middle pane. The VIX is at the bottom in blue. And using the skew, then running it through an algorithm that I derived, we come up with two other numbers. Beside the VIX, which in this case was 14, we're coming up with a skew-adjusted downside of 16 and a skew-adjusted upside of 12.2. And so, and that number, as the VIX changes and the skew changes, the upside VIX, or the upside and downside, I'm just going to call it upside VIX and downside VIX, skew-adjusted VIX. Those will change appropriately as well. We're mostly fixated on the downside, the skew-adjusted downside volatility. All right? That's the number that we're going to use in terms of determining what strike we should use, to sell premium at. We're not just going to plug in the VIX in OptionVue to get our one standard deviation. I'm not just going to use an at-the-money call IV. I'm going to use something higher than the VIX, and I'm going to refine it using the skew. Okay? I hope that's pretty clear. Now, I don't just use the volatility numbers here of 16. I want to know specifically the actual percent change in price being predicted by this. So I'm going to then convert this again using statistical math. I'm going to take that implied volatility to the downside and convert it into a skew-adjusted implied 30-day percent move to the downside. In this case, as of that day, what was that, April 25th? It was implying a 4.5% move to the downside. That's what that the downside VIX of 16 was predicting. 4.5% move at that time. And so that's the implied 30-day move. Okay? So, and here I'm showing you the specific. Okay, and then what I do is in my Metastock program, I can make these little bands, so that now, let's say that I want to put on a hedged bull put spread. I'm going to make sure that my short strike is at probably 1990 or so. I'm going to go to the first contract outside that one standard deviation level, that skew adjusted, using the skew adjusted VIX. So in that particular case, given where the VIX was, given where the skew was, I would sell the 1990s, 30 days out or so. Okay? All right, so let's see, what's the next screen? Okay, and that brings us to the question, of course, we got the implied move down. Now let's talk about the actual move. The actual move. So that's the second part of our volatility edge analysis and understanding SPX bull put spreads. Real simple concept here. All we do is take a close and we look forward to the following 21 days and ask ourselves, how far down did the SPX go from that close? Let's go. We count forward 21 days. We look at the lowest low, and shazam, there it is. In this case, that was a 1.9% move to the downside. All right? Real simple. And I can even graph it like that. And that's what I've done here in my Metastock program, is I've graphed the farthest move to the downside that occurred from every close that you see here. Okay, so you think you can kind of see where we're building this. Now, on that day, on April, 1st, what was the implied move on that time on April 1st? So remember, we have to go to the VIX, skew adjust it, and what we find is that on that day, on April 1st, the skew adjusted downside implied move was 4.1%. So would a bull put spread have worked out then? Well, absolutely. We would have sold premium 4.1% out of the money, yet the market only ended up moving 1.9% down. So shazam, that would have been a favorable bar to sell premium at. So we can, in retrospect, then go back and look. Let's see, what was my point here? Skew just implied. Okay, yeah, in this case, the one standard deviation would have been at 1987. Yeah, that was a different time frame for that, 1990. Sorry about that. The skew-adjusted implied one standard deviation level was at 1980. I would have sold the 1985s if those were available then, 30 days out. And real simple, failure of the SPX to decline below that means, in retrospect, it was a favorable bar for selling premium, for selling a bull put spread. I'm going to paint those bars blue. Do you see how I painted all those blue up here? All these where the implied move down was greater than the actual move down in retrospect. I'm going to paint all those bars blue. Boom. All of them are painted blue. And I label those favorable. This is in retrospect. Okay? I don't know if a bar is blue unless 21 days goes by, 21 bars, 30 days, then I can paint the thing. And so when I go back in time and do this for all the bars, what I'm going to do is paint the bars red that were unfavorable, where the move down turned out to be greater than what was implied. And you'll see here, for these bars here, we go forward 21 bars. Here's the one standard deviation. You could see this stinking bar over here that went down and tagged it. It tagged all of those. So all these were rendered unfavorable right there. All these were rendered unfavorable. All the rest were rendered favorable. This was, of course, back in June here, end of June when it blasted down to the downside. Okay? So we paint bars red or blue in retrospect. The most recent 21 bars will be black. We don't know yet, but we can go back in time and look and paint them blue or red, favorable or unfavorable for selling premium bull put spreads. Now, out of the entire history of the SPX going back to January of 2000, okay, we're going to determine the percentage that were favorable for selling bull put spreads. I mean, because wouldn't you agree? I mean, if 100% of them turned out to be favorable, well, then we would just sell bull put spreads all the time, right? Well, that's not the case. There's a healthy percentage of them that are indeed red. Okay, and so here they are. We're building the infrastructure here of understanding. So look at this, though. I mean, we have a lot of blue bars here. Clearly, there's a nice edge in the SPX for just selling bull put spreads a lot of the time. Here's the problem. When you get caught, you can really get caught unless you hedge it. And that's kind of what we're talking about here. What percentage of the bars would you guess were favorable for selling bull put spreads? Well, when you run the numbers, this took me a while in Metastock to program, figure out how to do it, but I did after a bit. This was up through earlier this last summer, August or so. Roughly 82%, 81.9% of all the bars going back in the SPX using the skew adjusted VIX, okay, as your short strike level. 81.9% of the bars turn out to be favorable for selling premium through bull put spreads, one standard deviation out of the money, bull put spreads. All right, so theoretically, if you put on a bull put spread after every close, all 4,200 plus bars going back, you would have made money on 81.9% of them. Okay? And now that means that they were never touched. Okay? The short strike was never touched, so you would put that on, and the market never did come down and touch that short strike at that one standard deviation level. We're not talking about it finishing below. We're talking about it ever touching. It never touched. Okay, 18.1% of the time, the market did go down and touch the short strike. It may have bounced off some of that time. It may have continued on down further to a huge level. But at least we know that 18.1% of the time, the short strike did get touched. Okay, so that is our benchmark baseline understanding of this. Now, what is the edge that this market has? 81.9 sounds pretty good, doesn't it? And instinctually, I think if you would agree, then you would be right. And so I want to just explore the statistical edge inherent in the SPX market. Because what we find is that the SPX market inherently has overvalued options. There's just this premium built in because it's an insurance device for so many institutions. And all in all, we're seeing an edge here. So let's just look at the statistics. I have three different probability calculators I want to show you. And what I'm doing is I'm plugging in one standard deviation levels to be the targets, and in this case, a boundary price. And so what you find is that roughly there is roughly a 30%, well, the probability of price touching either the first or second standard deviation, when you crunch through this, there's roughly a 30% chance that price is going to go down and hit the short and hit the border of that standard deviation. That is, if the volatility input into it actually comes to pass. If the market is as volatile, okay, if the market works out to be as volatile as your volatility input into this calculator, okay, then the one standard deviation level should get touched roughly 30% of the time. Here's the Hoadley, showing a 63.43% for both the one standard deviation to the up and the down. Trade King is showing a up there probability of touching, look at 29% and then 34.74% for the different standard deviations up and down. OptionVue has it just under 30, and this is using a Monte Carlo engine. So we're going to just say 30%. Roughly the probability of your downside standard deviation getting touched is roughly 30%. That's kind of what the consensus is working out to be. Now, if you take 30%, this is what it would look like. If the skew-adjusted downside VIX accurately predicts the actual volatility, the actual move, then we estimate the probability of the SPX touching that downside border at 30%. And this is what it would look like. 30% is where it was more volatile than implied. What actually happened? When we actually go and look at the physical move of the market relative to what was being implied, you have it was only getting touched 18.2% of the time. Am I off by that a little bit? I think I'm off by 0.1. The baseline edge then works out to be about 11.9%. It should be 11.8%. 11.8%. So there is an inherent edge that's pretty significant already just being in the market. Now what we want to do is try and time it even more so, to try and beat that timing even better. Wouldn't it be nice to crank that up to, instead of having 82% of the bars, if you flip a coin, you have an 82% chance of being right? Wouldn't it be nice to have that be like at 85 or 90? And avoiding the times when it could be like down at 75, where you're going to lose one time in 4. That could be a huge swing between getting 9 out of 10 right and having only 3 out of 4 right. That would dramatically change your life as a premium seller, particularly a directional premium seller. I hope you would agree. So I'm just going to show you one of the things that we do to try and squeak out a better edge than what's already inherent. And that is that I'm going to look at the distribution. We know it's at 82% roughly baseline. I'm going to look at the historical distribution of implied and actual after a certain technical setup occurs. Okay, and so here's the unfavorable bars in red. And what I'm going to try and do is come up with a technical analysis tool to cut out as much of the red as possible, and yet leave as much of the blue as I can. And so the best thing I have found over time is just a simple 50-day simple moving average is a good starting place. And this is the one I'm going to show you right now. We do also throw in stochastics into what we teach, and I refine the edge even more. And then I'll tell you a little bit about what I even do further in a little bit. But basically, just take a look at this 50-day simple moving average. And look, I've done studies on a whole bunch more. I've taken it from 10 up to 200. And this is just, strangely, it just settles in on a 50 being about as good as anything. But what you can see here is that if we only put in bull put spreads when price is above this 50-day simple moving average, we are cutting out a lot of the red there and leaving in a lot of the blue. Now, there's still some red above the 50, no question. But if you look at the huge chunks of red that we're taking out by, when it's below the 50, well, then that makes it kind of worth it. And so when we rerun the numbers then of all the closes above the 50, we're now squeaking out a bit more of an edge. 84% of all the closes above the 50 turn out to be blue bars. And so that's a start towards getting us into the upper 80s in any case. Likewise, if you traded bull put spreads when you're below the 50, you have a greater chance of connecting then, and you're going to move that down into the 70s then. Okay, of all the bars below the 50-day simple moving average, you're into the mid to high 70s in terms of the percentage that are favorable blue bars for selling bull put spreads. So that's a nice dividing line to divide up your edge. It's about the best single indicator I can think of for obtaining an edge for selling premium through bull put spreads here. It's an additional 2.1%. Okay, and some people wouldn't think that's much to shake, to write home about, but it is part of the picture. And if you were to be below the 50, think of it going the other direction down into the 70s, and then you can, having a rough go of it, 3 times out of 10, 4 times out of 10, that gets kind of tough. What I like to do is I add in stochastics to this, and I also have a price action component as well. And what I do is every week on our Discover Options YouTube channel, we post a little 20-minute video. I do this on every Sunday night. It gets posted late Sunday night, ready for the Monday morning open. And I give you a few different market reports, and these pertain to selling premium neutrally and also doing a likelihood report on the SP. And it's all on the SPX. But a lot of the same kind of technology is what we report here for my little 20-minute video on the weekends. And you can go to Discover Options YouTube channel. You can sign up for alerts when we post it. And I think you would find it to be some good information if you're a sophisticated premium seller, particularly in the SPX. Okay? All right. Let me see. Can I get out of this? And Tom, that's it. That's my presentation. Be glad to take questions at this point.
I don't see any questions yet, Steve. I did have a question. Do you have any kind of, I know it's available in the mentoring. Is this something that people can get independent of mentoring? Like, is it a standalone course or something?
We do have a standalone course where I go over this in the context of butters and condors. And then but we do have a standalone course. We try and teach those courses in a bundled package and then give a nice discount on those. But if you have some folks there that are interested, have them give us a call, and they can talk to James or Jeff here at the office, or Karen if that's who their rep is.
Sure. And is there any kind of ongoing thing besides the YouTube channel that you've got? Maybe something for like a subscription service for people that trade, say, SPX?
You know what? I am rolling out a signal advisory along these lines shortly. And I'm about 90% done with that, where I'm going to be rolling out a daily signal advisory on both bull put spreads, condors and butterflies, and then the more statistical likelihood report that we report on every weekend. But that is coming down the pike. I'm going to give it 2 weeks. It's pretty much all built out. But you'll be the first to know when it's rolled out there, Tom. I'll let you know.
Do you have any rough idea of what the pricing might be on something like that?
I don't want to announce it now. It's still up in the air a little bit. That's one of the final touches. I'm talking to our reps here about that exact thing. Yeah.
All right.
But it would be daily. And what I do is I take each day's price action, and I look at the price action, the position it is in the moving average and the stochastic, and then we take that exact market condition, look back in time to see how often it came about in the past and whether it had primarily favorable bars or non-favorable. and then we're able to kind of deduce whether it's a good time to put on a condor, butter, or bullput spread.
Oh, good. I look forward to seeing that, Steve. And then, do you have any data on it, on how accurate the predictions are, or what kind of results people can get?
Well, that's the sticky point, because it only tells you the likelihood of a favorable bar occurring relative to the past. And because everyone trades butters, condors, and you guys teach different strategies too. I mean, we all have our little angle on the premium selling, and plus everyone trades it differently with adjustments and everything. It's tough to quantify how much more money you would have made, because everyone's different that way.
Sounds like it's more of a biased estimate.
Yes, we're just simply reporting on the edge you would have relative to the past for the likelihood of a bar leading to a more calm behavior or more volatile behavior.
Well, when you get it ready, I'd sure love to have you back to show it off and give people a chance to sign up for it. Yeah. Oh,
that'd be awesome. I'll take you up on that. And it's the final touches are being done on it. I'm using a platform that allows me to host some videos to explain it all, and then I'll just post the files on the website that people can get to with their account and everything.
Sounds great. Well, I don't see any more questions, so I guess with that, we don't need to keep people longer than they need to. So, Steve, really appreciate you coming on and sharing that with us. This is pretty interesting stuff you're working on.
Well, it's been a lot of fun. It's been a long time in developing. I've had to dive into Metastock like crazy and learn that language and be able to do this. But I think it's going to be rewarding, and I think it should help people that are into selling premium in these sophisticated approaches.
Absolutely. Well, thanks again, Steve. We'll wrap it up, and then just like I said, let me know when you've got the bow tied on your new service, and we'll let everybody know about it.
Excellent. Thanks so much. Thanks for having me.
We'll see you, Steve. You
bet.
I
appreciate it. Bye-bye.